Let's start with the main point. NVIDIA's earnings were strong, but the stock still fell hard. If we call this normal profit-taking, we may miss what the market is really worried about. The market is no longer focused only on revenue growth. It is asking a harder question: can that growth continue with the same margins? In the AI hardware cycle, strong sales can still create future risk if supply chain investments and purchase commitments grow too fast. NVIDIA beat expectations on both revenue and earnings. Even so, the stock dropped more than 5% and the Nasdaq also moved lower. Some commentary focused on China-related guidance, and that mattered. But the bigger issue is AI return on investment and margin durability across the AI ecosystem. In simple terms, the market is now asking, can customers keep spending at this pace? Can these high margins hold a few quarters from now? Could large commitments become a burden later? That is why NVIDIA is being debated so aggressively after a strong report. Bulls see rising commitments as confidence in demand. Bears see a risk if hyperscalers slow AI infrastructure spending even a little. Margin pressure could rise quickly. So the real debate is not, was the quarter good or bad? It is, how long can this structure hold? And this is not just about NVIDIA. The broader AI infrastructure chain matters too. Companies like CoreWeave show why investors are more cautious. Revenue can grow fast, but profitability does not always improve at the same speed. If losses widen or margins come under pressure, the market reacts immediately. AI infrastructure expansion does not automatically mean easy profits. These businesses can produce huge top-line growth while still burning a lot of cash. If profitability does not catch up, the stock can become very volatile. That is why the market is asking tougher questions. Now, what is the quality of earnings? What does cash flow look like? Can margins be defended? If management cannot answer with numbers, even a strong earnings beat may not support the stock. At the same time, legacy software companies are responding differently. They are buying time through cost cuts and capital returns. Block announced major layoffs and framed them around efficiency and productivity. The market's question is simple: does this reduce costs now and improve cash flow? Salesforce's large buyback can be viewed the same way. Bulls see confidence. Bears see defensive capital allocation in a market that is becoming less patient with slower growth software names. Either way, the market now wants proof in three areas: free cash flow, margins, and pricing power. So on the hardware side, the question is whether margins can hold. On the software side, the question is whether companies can protect profitability while AI pressures traditional models. The S&P 500 fell less than the Nasdaq, and part of that may be because geopolitical headlines temporarily helped sentiment. Reports of progress in U.S.-Iran nuclear talks may have eased short-term energy risk concerns. Weekly jobless claims also came in relatively low, supporting the view that the labor market is still holding up. But these headlines do not solve the deeper issue. The core driver is still inflation and interest rates. AI excitement can support sentiment, but if inflation stays sticky and bond yields move higher, tech valuations can come under pressure very quickly. That is why the PPI report matters. If wholesale inflation comes in hotter than expected, the market may price in more persistent inflation. That could push the 10-year Treasury yield higher, and high-valuation tech and long-duration growth stocks would likely feel pressure first. So here is the takeaway. Today was not just a simple earnings reaction. The bigger signal is that investors are evaluating the AI cycle with stricter standards: not just growth, but margin durability; not just story, but cash flow; not just optimism, but execution. When you look at AI stocks, do not focus only on revenue growth. Look at cost structure, margin stability, and whether customers can sustain the spending behind the story. That is what the market is repricing right now. This is not financial advice. Watch margins and cash flow. I'm Wilson, and I'll see you tomorrow.